Scoring at will.
Andy.
All right, I'm ready for that. Yeah.
You're good.
Call this meeting to order. Stand, please rise for the pledge of allegiance.
I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all.
Okay, let's start up. First of the meeting, we've got reorganization, election of officers. Currently, we have Councilman Andy Bozak as president and Commissioner Barb Reddick as vice president. I will entertain motions for...
I second.
Okay, we've got a first and second for Andy Bozak for foundation president. Do we have any other nominations? Any discussion? Hearing none, all those in favor, or is this a roll call? This is probably a roll call.
We really need a roll call for that.
First roll.
It wasn't on the list. Okay, let's start with that. Roll call, please.
Bozak.
Present.
Ragnar.
Here.
Big.
Here.
Say that.
Morales.
Here.
Vasquez.
Here.
Stone.
Here.
Harris. Here. Rivas.
Here.
Sims. Richter. Nine.
Okay, do I need to redo that motion, or can we go with this?
No.
Okay, so we had a motion for Andy Bozak as foundation president. Hearing no discussion, let's do roll call, please.
Ragnar.
Yes.
Big.
Yes.
Morales.
Yes.
Vasquez.
Why not?
Stone.
Yes.
Harris.
Yes.
Rivas.
Yes.
Sims.
Yes.
Bozak.
Yes. Okay, next we have foundation vice president.
Make a motion of Barbie foundation vice president.
Okay, we got
Second.
First and second, any other nominations? Hearing none, any discussion? Roll call, please.
Big.
Yes.
Morales.
Yes.
Vasquez.
Yes.
Stone.
Yes.
Harris.
Yes.
Rivas.
Yes.
Sims.
Yes.
Bozak.
Yes.
Ragnar.
Yes.
Nine.
Okay, first up, thank you guys. First up, we've got new business resolution transferring foundation earnings transfer for $9,181,282.04. If I can get a motion to accept the resolution.
Second.
Got a first and second, any discussion? Hearing none, just a voice vote. All those in favor signify by saying aye.
Aye.
All those opposed, same sign. Motion carries. Resolution transferring foundation earnings from foundation's holding fund to the foundation budget fund for the full 2026 approved budget amount.
What was that amount?
You guys have the amount here?
$9,181,282.04.
Oh, it's just. Okay, we need a motion.
I'll make a motion, Mr. President.
Second.
Got a first and second, any discussion? Hearing none, all those in favor signify by saying aye.
Aye.
All those opposed, same sign. Motion carries. Next, we've got an amendment to the investment consulting agreement dated January 1, 2016. And
It's your updated annual every year.
that's the one we do every year. So I need a motion to accept it, or questions.
So it says it's an amendment. Can one of our attorneys just tell us what the amendment was?
The 2026 calendar year.
Oh. And was that approved?
You got a first, we have a second?
Second.
Okay, any discussion? Hearing none, all those in favor signify by saying aye.
Aye.
All those opposed, same sign. Motion carries. Next, we are to Capital Cities presentation. Floor is yours, sir.
Awesome, thank you guys. Just as a reminder, my name is Corey Waddell. I'm Director of Consulting at Capital Cities. I've got a couple items to cover here today. We're going to start with a look back at 2025 markets and an outlook for 2026. It'll be the first tab in your guys' books up there. So if you can flip ahead just to page 3, we can see the topics. So, macroeconomic backdrop in 2025, we ended the year with a pretty resilient economy, looking at a lot of the broad macroeconomic indicators. So at the top right, we're showing CPI, or inflation, along with the unemployment rate. If you remember back, CPI peaked back in 2022 when we had some inflation scares. Long-term expectation for CPI is 2%. We're not there yet, but we have definitely moderated and continued to moderate since 2022. Unemployment was relatively unchanged for 2025. At the bottom left-hand side, you can also see a couple key economic indicators there, real GDP and real PCE, both coming in positive and remaining in line with expectations. On page 4, we can see how investment market returns played out quarter by quarter here as it relates to broad asset classes. The blue bars are your equity returns, both U.S. and international. And then we have fixed income results that are green, orange, and then cash is yellow. So most of these bars are positive quarter in, quarter out, meaning that we had overall a positive market for 2025. Equity markets really drove the overall investment portfolios for diversified investors in 2025. We saw both U.S. and especially non-U.S. equities actually advance strongly in 2025. We also saw fixed income not only be a ballast, but be a return provider for 2025. It was a positive return income generating asset class every quarter of the year. On page 5, we can see how that distills down into some calendar year returns for broad asset classes and indices. So I'm going to focus your attention on that bolded blue bar. That's the 2025 calendar year returns. So that top row there is just broad U.S. equity. The Russell 3000 index, you can see, was up over 17% for the year. Another really banner year for U.S. equities here. Albeit we still were dealing with some turbulent times. April was really bad. We dropped about 10% intra-month. But overall, the market has continued to expand. A big narrative of that has been large cap equity. You can see that right below, up over almost 18% for the year. Continuing to outpace small cap equities. That's another narrative that we've continued to see play out for the past 4 or 5 years, is that larger cap equities really dominating capitalization, our capital flows, and beating their small cap peers, which is different from what we see traditionally. On non-U.S. equity, I mentioned this, but we had a really strong bounce back year for non-U.S. developed and emerging markets, both up over 30%. So that was something that's been out of favor over the last several years compared to its domestic equity partners. And so, again, that's been something that helped bolster returns for 2025. And then fixed income, broad fixed income returned 7% for the year. Again, that might seem modest when looking at equity market returns, but that is very solid performance out of our stable fixed income assets. And then at the very bottom of the page, you can see cash still returned 4% over the course of 2025. Annualized returns on longer time periods, you can see 5, 10-year returns on equity market returns, now in the teens. We typically will say equity market returns, the average more like 8 to 12% long term. So these last 5, 10 years have been a pretty bullish environment for equities. On page 6, changing topics a bit and switching to interest rates, we are looking at the U.S. Treasury yield curve. And just as a reminder, this is a plot of the U.S. Treasury bonds over different maturities at any given point in time and what they are yielding. It's a good backdrop for the overall health of the overall fixed income market. So the bold blue line there that you see, that's where we ended 12/25, December 25. The dotted yellow line and the dotted orange line are where we were at year-end 2024 and year-end 2023. Not much has changed, but we can see the front end of the yield curve has fallen quite a bit. And that's all due to the Federal Reserve enacting some interest rate cuts that you've seen over the past couple of years. This has normalized the interest rate environment, meaning that shorter-term interest rates are lower than longer-term interest rates. If you look back to where we were at year-end 2023, a 3-month bond was earning 5.25%, 30-year bond was yielding 4%. That doesn't make a whole lot of sense that you would lend out money for 40 years and accept a lower rate. So we're getting into a much more normal fixed income environment, which is healthy for the overall economy. On page 7, keeping on the same topic, in terms of the short end of the yield curve, the Fed, what we saw in calendar year 2025 was the Fed cut interest rates 3 separate times for a total of 0.75 percentage points. And that brought the total Fed funds rate target down to 3.5 to 3.75. That's the lowest that we've seen since 2022 when we spiked, but again, still above where I think the Fed wants the long-term rate to be. Year-end estimates right now are only implying one Fed cut for calendar year 2026, but we're expecting that narrative to continue to evolve as the year moves on. It's always one that has a pretty volatile narrative as it relates to the news. We're also expecting the new Fed chair to be announced within the coming weeks here. That will take, he or she will step in beginning in April, and so that will be a whole new level of information that everyone will need to digest, whether or not their policy will be more hawkish or dovish. On page 8, continuing in with the fixed income markets, just a couple charts to show you here. Really, fixed income, as I mentioned, has been very positive for diversified asset allocators. We're seeing yields well above 15-year medians for almost all sectors of fixed income. However, some of our more risky areas of fixed income are, the spreads are tightening, meaning that those assets are not looking cheap relative to just a treasury or a high-quality fixed income bond. With that said, where the fixed income market is right now gives us great confidence in it being a great balance. If we see rates fall within fixed income, we'll be conditioned to have a big boost within our prices. But where we're at right now with yields, even if we see a rate increase, we won't see that much of a downfall as it relates to the prices. On page 9, switching gears to the equity markets, a big topic in 2026, but it's been really for the last 3 or 4 years now, has been the overall concentration of the equity markets. So over on the left-hand side there, you can see what this line chart is showing. It's just the percentage weight of the S&P 500 of the 10 largest stocks in that index. It's a market cap weighted index, meaning when a stock gets bigger, it's going to make up a bigger share of the index. And so you can see we're at the most concentrated we've been over the last 3 decades as it relates to the S&P 500 index, meaning those 10 largest stocks weight for almost 40%. You can see those laid out there in that tree map, we call it, that colorful chart there. A lot of these stocks are also correlated, meaning that they're all residing in information technology, and then the ones that aren't in infotech, Google, Facebook, Amazon, Tesla, I think we would all say that those are tech-related companies or very closely related. And so, again, a lot of concentration around a lot of the same narratives.
Are you pointing that out that something is scary, or just pointing it out?
Just pointing it out. It's been driving returns here. I'll show you on this next page what it's meant for the overall markets.
Thank you.
Yeah, so on page 10, what this has meant for the overall returns of the S&P 500, you can look, we have this chart that breaks down the calendar year returns of the S&P 500, and then below that is the calendar year returns of what we call the S&P 497, that excludes the MAG 7, and then we show the MAG 7, which again are those Apple, Amazon, Google, Facebook, Microsoft, NVIDIA, and Tesla. So over the last 5 years, you see that index return share at the bottom. those 7 stocks have made up that positive return of the S&P in that percentage. And so this is a good thing when you're holding the S&P 500 index. It's a challenging thing when you're a stock picker and you're having to choose between Tesla or the smaller mid-market EV, or if you're choosing between Google or the small market company. Just because if you're not holding all 7 of those names in market weight, you're not keeping pace with the S&P 500 likely in year in, year out scenarios. That's further described in page 11 when we show you this active versus passive management chart. The chart on the right is a little difficult to explain, but that black chart, you can just think of that as the S&P 500 return. Oh, we're on page 11 up here now. Yep. The orange line is when active management, the average active manager, or the median, has performed better than the S&P 500. And then the gray bars, or the gray area, are all of the different active investment managers. And so you can see over the last 3 years, that median line in most of the universe is trailing index returns. It's just not been an advantageous place to be, given the capital that has flown into those largest 7 to 10 names of the index. Again, the portfolio has benefited because we have passive management that has market weights in those select names. But this is just to set up some explanation of why active management has also been very challenging over the last 3 years. Page 12, just to reinforce some portfolio tenets that we have. Just as a reminder, this portfolio is just equity and fixed income, so ignore the alternatives on the far right. But within equity, again, we want to balance that active and passive management. Active has definitely been out of favor over the last several years, but when we start to see some volatility, we do want hands on the wheel. We don't want to go fully into passive, but those passive markets have helped keep our fees low, and they've helped boost our returns over the last couple of years. Within fixed income, it's a completely different story. We're seeking all active fixed income. We allocate to different sectors of the fixed income market, given the fact that we have a good chunk of the portfolio within that. So we have some diversified fixed income, we have core plus as well as defensive. Then focusing on page 13, our fiduciary calendar for the year. This should all look familiar to you all, but again, this is the calendar that we put forth each year to cover all of the fiduciary obligations that we all have over this investment program. And so next quarter, we'll have the portfolio construction study. This is where we take a fresh look at the risk-return expectations for the overall portfolio, make sure that still aligns with all of our expectations and our budget and our planning goals. In the third quarter, we'll take a fresh look at the investment policy statement, make sure that there's no updates that need to be made there. That's also a key fiduciary responsibility. And then at the end of the year, we'll do a rehash of our comprehensive fee analysis to make sure that fees are still in line and that we're not paying undue fees.
That's good.
All right, so I will switch gears and go behind tab 1, and this will be our performance and evaluation report, different PDF. It's the far right one there. Yep, that one. Okay, so on page 1, our considerations and observations. Again, this is typically our agenda for the meeting. We just had our annual market review, set the stage for the overall portfolio year. Another action there, just as a reminder, in December, we were notified by one of your active equity managers, the Prospector Opportunity Fund. That prospector was going to be closing the shop at the end of December, which would in effect close that mutual fund. So what we did that same day that we were notified, we worked with staff got those assets moved into a small cap value index fund, the Vanguard Small Cap Value Index Fund as a placeholder. What we brought you today is a search where we can select a new active equity manager to fill that space. So I'll cover that after I cover performance. The other note here was the annual distribution that you all voted on before my comments. I'm going to skip over the market overview and the performance and evaluation because I had a lot of comments on that in the annual market review. But we can land on page 5 to show you total performance as of the end of the year. You can see in the blue bar there in the middle of the page, the total portfolio ended the year at $207,160,487. The asset allocation is up at the top right, and you can see the rebalancing compliance chart at the bottom right. No need for any discussion as it relates to rebalancing. We're a little bit overweight equity as of the end of the year, given the appreciation that we've seen, but still well within our 5% target. Some summarized performance on the total portfolio there at the bottom left. For the quarter, for the fourth quarter, we were right in line with the benchmark, up about 2%. Year-to-date, the portfolio up 12.5%, trailing our passive benchmark there at 14.6%, just slightly. Very, very strong, again, year for asset allocators. This portfolio only having a dedicated 55% allocation to equity. We're really targeting more like a 6 or 7% return on a calendar year and out basis. And so the year that 2025 gave us with 12.5% absolute, very positive performance. I would say really all of the underperformance relative to the benchmark on the calendar year is coming from our active equity managers or the diversifying equity pool. Again, I mentioned this as part of the market overview, but it's just been a very challenging environment for any type of stock picker, given the concentration that we've seen in the overall markets. We want to participate in these up markets when we see very high volatility on the upside, but we're okay when we're trailing a couple percentage points on the upside. We want to definitely protect on the downside so that when we see bouts of volatility come, that's when the portfolio is outpacing the benchmark. I did have one other update as it was related to performance. We have seen continuation of the equity market returns here 2026 so far, calendar year to date. As of yesterday's close, the portfolio sat at $211,631,000. So that represents a positive about 2.3% gain just year to date here in 2026 so far. Are there any questions on performance? I do want to save time for this replacement search I have as well. All right, so we'll switch to the third PDF that you have over there, which is behind tab 2. And we can land on page 2 here. And so, again, just as a reminder, what we saw in December was that Prospector, which manages the Prospector Opportunity Fund. Right here. Which was one of the small cap value managers within the overall portfolio, notified us that they would be shutting down the business at the end of the year. And so the two senior portfolio managers have reached a decision. This is a boutique firm, by the way. It was not like a huge shop, but they did manage, tens of billions of dollars. But the two lead managers ultimately decided that they both wanted to retire at the end of the year, and rather than try to plan some rush transition, they announced that they were going to step away and shut down the business. So we wanted to make sure that we were, first the exits of this fund, so we got out, got into a placeholder, which was the Vanguard Small Cap Value Index Fund, investing in the same area that Prospector was investing in. But what I brought you today is 3 possible replacements that are active managers in that space. So on page 3, you can see the summarized candidates here. On the left-hand side, we have River Road Asset Management based in Kentucky, which is majority owned by Affiliated Managers Group. They solely invest on value investing in the U.S. equity space. Another boutique manager with about $11 billion in assets. Very stable group, portfolio manager, been on the strategy since 2005. Really strong focus on downside protection with River Road. And you can see the expense ratio coming in there at 1.06. Just for reference, Prospector was priced at 1.16, 1.16%.
What is Vanguard Small Cap Value Index Fund? What's their expense ratio?
I believe it's 8.08.
0.08.
Yeah.
Okay. That was my next question. If we defaulted the Vanguard Small Cap Index, why would they include it in a search for active,
The search was to find a replacement for Prospector, which was an active for active search.
Right.
There could be a conversation if you'd like to reduce fees and keep a position in the Vanguard Small Cap Equity.
I was just a thought. I just was curious why they wouldn't have at least that included in the search. So,
Is
it was viewed as more of that placeholder, and so that was just how
Vanguard not actively managed? Is that-
No.
So you're getting this actively managed, that's why it wasn't included?
Right.
Okay.
Yeah, so when we terminated Prospector, we wanted to have similar asset exposure, and so we hired a manager managing an index in that space. You would still have that similar exposure, but yeah, these are active versus active.
out of curiosity, are we going to be voting on one of these tonight, or?
You can.
No, I was just, if we weren't going to vote on it tonight, I just wanted to know if you could bring back, if we don't vote on it tonight, the Vanguard, how they do compared to these 3 with fee-adjusted returns.
It's not a priority to vote on it tonight.
Would you feel it's in a good spot right now with Vanguard?
It's invested. You're not out of the market. You're not
But the
like
returns
this.
aren't going to be potentially as high as these, is that
No, you can't say that.
more of a risk? That's why I'm not saying it, I'm asking.
Yeah, no.
I want to answer.
I wouldn't say that. It's dependent on how these perform versus the market.
How's it been tracking as of late, though?
What's up?
How's it been tracking as of late?
Which,
Vanguard.
the Vanguard is just an index, so it's been tracking the index.
Maybe you need to explain what you're saying there. What do you mean when you say it's an index?
Okay.
Because you said it and we
Yeah.
had a lot of questions, but
Yeah.
I'll just elaborate on it.
Yeah, so all of these managers are tracking the Russell 2000 Value Index, which is a composite of stocks that Russell puts together of companies that all have similar type of metrics when looking at their balance sheets, forward growth expectations, so on and so forth. And it's meant as a broad basis that you can invest in this subset of the market. It's wholly inclusive. Vanguard, what they're doing is they just have a computer algorithm that says, I want to replicate what Russell has constructed as the small cap index. And we're going to just say we want to invest in that, and we're not going to have any active decisions based upon that. And because that it's technically just a computer system that's running that, that's why they can offer a very low fee for it, because there's no, real management. Whereas these active managers, what they're doing is there might be 600 to 700 holdings in that Russell 2000 Small Cap Value Index. They're selecting, maybe we want 60 to 70 of them, or in Boston Partners case, they hold 130 or 140 of them. they're definitely buying and using. So you're gonna have varied performance from an active manager than you would if you just say, I want to select this whole universe of stocks. And so, again, it's the same concept that I was talking about with the performance of the overall markets. We've seen a few stocks really driving everything because they've made us such a big part of those indices. Does that explain your question?
Yeah, I mean, basically, I used the wrong word, but basically it was, Red was mentioning that, how does it compare to these guys? And we have to know that.
Yes, absolutely. And so what we had before was an active equity manager, prospector, who was playing in the small cap value universe, selecting, 50 or 60 different stocks for their
Roughly,
portfolio.
how much in dollars and what percentage portfolio does it represent?
Yes, so, let me get the value. The percentage is 4%. The value is about $9 million. And so again, what we did in December, when we were told that your active equity manager was going to essentially shut down their business at the end of the year, we swapped you out for the index to give you a similar exposure as a placeholder, so we could review the overall market with you all to make a decision for a replacement.
So what I'm hearing, and correct me if I'm wrong, is that you would like to compare these three versus the Vanguard small cap, so we can see returns, see all the information. Unless you can tell us right now why Vanguard why you're not suggesting to leave that Vanguard. What's the benefit to moving into these three?
That it was active for active.
It's just active for active.
And now,
The other thing too, is understanding, like, the River Road, which I really happen to like, that you have recommended, they only have 60 to 70 holdings, which is about 10% of the index. So they're trying to pick the best of the best out of that index. Just because you have them in that universe doesn't mean they're all going to perform. And what these money managers have the ability to do is listen in on their investor calls, have a better understanding of what's going on in the company, whereas the index is not thinking, they're not doing any analysis whatsoever. So you're just going to get the broad average of the good and the bad and the ugly, and however that turns out. The other thing that I like about the River Road that you said is that they're strong on their downside protection. And when it comes to small cap stocks versus large cap stocks tend to be a lot more volatile, so your swings are bigger. And if they have the ability and they have some magic methodology that they are using to limit the downside and protect us on the downside, I think that's a strong case for that fund.
yeah, why don't you let me walk through what I brought today, and then we can either talk about whether we want to look at one of these replacements, or we can bring back additional analysis where we're comparing, contrasting these versus a passive track, because I think that's kind of what I'm hearing right now. But real quick, while we're on this slide here, Boston Partners, much larger firm based in Boston, focused on value investing, but both U.S. and international, over $120 billion in assets. We've worked with Boston Partners for a number of years within their small cap values space. Larger fund, more diversified, meaning you're going to have about 140 holdings in this versus a more concentrated portfolio of two. And then finally, Diamond Hill on the right-hand side, another boutique firm headquartered in Columbus, Ohio. We've worked with them with one of our public funds dating back about a decade, very niche investors within the value space as well. Theirs a bit smaller, and the strategy is also smaller, and so that's a consideration while we look at this.
What is the comparable small cap growth fund that we have?
The comparable Congress.
No, I mean the complementary.
Complementary, yeah, the Congress small cap growth.
Okay.
Yeah. So again, when we're looking at the overall portfolio, and that's a great question, Laura, This is one of our 5 active equity managers that's playing a role of small companies in the United States that have value-type balance sheets. And we have a complementary fund that invests in small company stocks that have more growth-style balance sheets. And so page 5, I want to show you a couple, just highlight the performance here, really highlight a couple things. On the bottom of this page, you can see calendar year returns for all of our our candidates here relative to the Russell 2000 value. I want to point out calendar years 2022 and 2018. These were definitely challenging years for the markets. 2022, we had big inflation scares. You can see River Road at the top-hand side. This is what I was talking about as it relates to downside protection. Each time we've seen a really, really volatile downside market, River Road has protected capital. And so that is really why we've identified them as such a strong candidate, given their ability to identify these more resilient companies and balance sheets. On page 6 and 7, or specifically page 7, I wanted to show you this 10-year up-down market capture chart. And basically, you can see River Road down at the bottom left-hand quadrant of that chart at the top. The x-axis, the down market capture. That's saying any time that we have a down market, River Road is only capturing about 66%. And so that's just really, really strong downside protection that you don't see out of a lot of managers, and one that we like in this space. We think Boston Partners and Diamond Hill have both had solid performance, hanging there, a little more upside market cap participation, not as much on the downside. Page 8, again, this would be our recommendation, if we have one for today, would be to replace the prospector opportunity strategy with the River Road. This would actually be subbing out the now Vanguard small cap. Again, we really like the fact that River Road is boutique, that they're nimble, they haven't changed their stripes, and they continue to show this downside protection over time. Their fees are competitive and are in line with their peers. So again, I guess if there was going to be some more analysis given comparing and contrasting these managers to a passive track, we could bring that back and you could vote on that on your next meeting, and you would still be invested in the marketplace within this strategy. But what we had today for you was just bringing an active versus active replacement for you.
I'm fine with that if you guys want to vote on River Road. I just was curious as to why Vanguard was, a good place to hold the money instead. Because I know usually index funds with their costs are practically hard to keep. I do see where it does offer 2018-22 some downside protection. 2025, the Russell being 12 and River Road being 2, but every other year they did well. So I have no. Are these return adjusted as far as for costs?
Yeah. All of those are net.
Okay.
Yeah. And that's a great question, Brad, with the active versus passive to begin with. So thanks for coming.
Well, just from my experience, that downside protection is really good. I don't think I've ever seen a manager that does that good of a job. It's really exciting, especially in the small cap arena. That's a good job.
All right, well, if you'd like to move forward, I need a motion to, what you guys want to do? Does anyone like to make a motion?
I'll make the motion. I didn't even know you have the water, just a question. I always go after index funds, because it's just, they're so hard to beat.
What's the motion?
That we,
River
Road Small Cap Value Fund.
Okay, we've got a first, we have a
One
second.
second.
Okay, have a first and a second, any discussion? Hearing none, let's get roll call first.
Bozak.
Yes.
President.
Yes.
Diggs.
Yes.
Morales.
Yes.
Mattson.
Yes.
Jones.
Yes.
Harris.
Yes.
Rivas.
Yes.
Tim.
Yes.
Reichner.
Yes.
Ashland.
It's your vote.
Oh, I'm sorry. You were talking to me, I'm going, yes.
10.
Okay, motion carries, or motion passes. Okay, next.
Yeah, so we'll have a couple follow-up items for you. We'll send a trade sheet over for this action, and then we'll also have the trade sheet to raise the annual distribution. So we'll get back with our team tomorrow, get that stuff working, and then we'll have some operations to work through. But we'll get all that completed for you.
Thank you. Thanks for making the drive up.
No, absolutely. Yeah.
All right, next up, we've got the attorney's report.
I have nothing at this time.
Okay. Next, we have any other matter that comes before the board. First up, we've got the approval of claims, Capital City's fourth quarter for $16,250, the normal claim.
Move we approve.
Second.
First and second, any discussion? Hearing none, all those in favor signify by saying aye.
Aye.
All those opposed, same sign, motion carries. And then, do we have public comment in this meeting, or no?
No.
Looking for a motion to adjourn?
So moved. Second.
First, second. Any discussion? Hearing none, all those in favor signify by saying aye.
Aye.
All those opposed, same sign, motion carries.